Have you ever found yourself in a situation where you take a trade and price moves few pips into profit? Then, with your knowledge of risk and trade management, you move your stop loss to break even, hoping to preserve your capital from further losses, right? And then what happens is that price comes back, take you out on a break even, and then moves in your direction massively. Trust me, this can be very, very frustrating. So today I'm here to share with you two powerful strategies that I use. And believe me, this strategy will help you to avoid the frustration that comes with such circumstances of hitting your stop loss before moving in your direction. So real quick, before we delve into the chart, if you're not subscribed to the channel, please do well to hit that subscribe button, turn on post notifications so that you don't miss out on other future important videos. So let's step into the chart and let's see what we have for today. Okay guys, so welcome back to the chat. So like I said from the intro, I'm going to be showing you this two powerful technique, right? That will help you and save you from that frustration of moving your stop loss to a break even and then price comes back to take you out on that break even before it moves in your direction, okay? And I'm going to be using this particular trade that I took on 5th August as an example, like as a live scenario for you, okay? And the reason why I am using this trade is this trade also has something good that you can learn from, okay? So in as much as I'm showing you this two powerful technique, I'm also showing you the reason behind this particular trade that I took. So you are learning about two things in one video, okay? So you might want to stick around to the end, yeah? So real quick, let me show you what I saw and how you could have escaped this frustration that comes with taking unnecessary break-evens, okay? Great. So right in here, I'm not going to go into the higher time frames because I have talked about this in one of my breakdown videos, right? So H4 was bullish, and then right in here we can see that this was the last high that created this low on M15, right? And then fast forward, we had that break of structure to the upside. So M15 is bullish, aligning with the H4 bullish structure. Now, after every break of structure, we know that there is a higher tendency of price making a retracement into certain levels before it makes the continuation. And so the same way, coming onto the chart in the morning, I saw that I have all of these areas for price to get into, right? So I have this first point of interest in here from M15 and the second point of interest right in here, which also had all these liquidity pools lying above it, okay? So I knew that I needed to come into one of this point of interest to look for my continuation to the upside, right? So real quick, let me step into the 5-minute time frame and let me show you a little bit insight into how I got into this trade, okay? So right in here, look at what happened in here. And this has been taught in one of my videos where I talked about one of the variants of the Asian session liquidity, right? So here we can see that we've had that 5-minute break of structure to the downside, right? After that, what do we see in here? We have a lot of imbalances in here. Now, ask yourself that why didn't price make a retracement to at least fail this imbalance before it made a push down? Okay, now this comes to that variant of that Asian session liquidity, where if I take my Fibonacci from the low to the high of the Asian range, you're going to see that we had this beautiful candle in here that was lying right within the mid-Asian range, right? So that was a point of interest to watch. However, because I don't trade Asia, I wouldn't be taking this trade. But then after seeing this candle mitigating that point of interest from mid-Asia, right after that, we can see the price made another push to the downside, breaking structure, giving me a new leg to work in, right? So right after that, I know that my new leg that I'll be working in is from this high to this low. And remember, I am looking for a retracement into those demand zones below that I showed earlier, right? And so seeing this, first break of structure, second break of structure, I am convinced that price really will make that retracement to the downside or into all those points of demand that we marked, right? So real quick, I'm going to step into M1 and show you the entry, right? So here on M1, we can see that we have this point of interest that was marked from M5, right? And right within that point of interest, this was the first high that was created in London Open. If I put my crosshair, you're going to see that it was 7 o'clock. 7 o'clock in the morning, that is when London opens, my time. Okay, 7 GMT. Now, this London high created equal highs in here within that POI, right? And so we had that first grab of liquidity, that is grabbing the London high right into that point of interest. After that, what do I see? I see this beautiful confirmation right in here. Okay, and so I go for my short. So right in here, I go for my entry, right? And my stop loss will be right above, the structural level. But what I do is that I add a few pips to save myself from any unnecessary spikes that may happen, right? So something like giving price enough room to play out, right? And then where is my target? My target is to any of this point of interest that I've marked. So let's say to this first low, right? For 17R. Now look at what happens. So right after getting, this heavy move of price into profit, right? You are aware that you have broken structure to your left. And so you can move price to or you can move your stop loss to a break even, right? So real quick, break even. Nice. And so you've moved your trade to a break even. You are trying to preserve your capital. And then what happens is that price comes back and taps into your break even, or it takes your trade out on the break even, and then it moves massively in your direction, just like what it did in this trade, right? And believe me, it is very, very frustrating. So now let me show you why this happens and the two powerful techniques that you can use to avoid this frustration, okay? So this is why this happens. Now, over the years, I have studied that price does this all the time, and this is why. So remember, market moves with money, right? We need liquidity to move the market, right? So the bigger institutions, the market makers, or whatsoever that you call them, right? In case they want to, push price to the downside, let's say their real intention is to make a push to the downside, right? And let's say they're having like $1 billion to make this move to the downside, right? What happens is that they don't release the whole $1 billion like that. If they do that, the market is going to crash, okay? So they release it in bits. Okay, they release it in bits. So what they're going to do is that, let's say in here, they are going to release $300 million just to make a push to the downside, right? And this is where they establish their real intention. Okay, so after establishing their real intention, what they do is that, we need money to move the market. And so they are going to inject another, let's say $200 million to make this retracement to the upside. Now, the reason for this retracement is not to fly price all the way to the upside, right? The reason is to just induce other retail traders like you and me, whether you're a smart money trader, you are support and resistance or whatsoever. The real intention of this retracement is to induce us to join in this buys. Now remember, if retail traders are joining in this buys, right, other bigger institutions equally join in this buys, there are going to be enough money in here, a lot of money in here, right? But then remember, the real intention is to make price dip to the downside. So all this retracement, all this move is a fake move to induce us to buy. Then after buying, after they've seen that there is enough liquidity that has been injected within this fake phase, they now inject another $300 million to do what? To make that continuation to the downside, right? Now remember, they have injected $200 million and that wasn't their real intention. So they need to come back to take out this $200 million that they first injected right in here, right? So they are going to again inject another 200 million right in here to come back and mitigate this previous orders that they placed in here. Okay, so they come back, mitigate those orders, right, to nullify or to break even on all these monies that they put in here. And then now they can now move to the downside. Now after moving to the downside, sometimes you may not have price coming back again, right? But then what is going to happen is that price will even come back in the near future to mitigate and then continue with a move to the downside, right? So how do you escape, these traps? And that is where my two techniques come into play. Okay, so the first thing that you can do is that if, for instance, you enter a trade in here, right, and we see a break of structure, the first thing that you can do is that instead of moving to break even, wait. Okay, that is why this business or this game is a risk. However, we know that it is a calculated what risk, right? So having the knowledge that we have an edge that always plays in our favor, we are not scared to take the risk. So instead of moving to break even, what you're supposed to do is that wait for price to what to make that mitigation, right? And after taking out this low, then you can move to break even. Okay, so that is what I always do. But then there are also situations where even after taking out those lows, price will still come back into those levels, and that leads us to the second technique, which I'm going to talk about right now. So you can see from in here, right? We made this push to the downside, we make a retracement, and probably let's say you had a trade in here to sell. So applying the first one, you wait for price to what? To take out this low. But then we can still see that price comes back because our entry would have been somewhere in here, right? So at this point in time, you might have broken even, but then price still comes back to take you out. And this is where you can employ this second technique. So the second technique is instead of moving to break even, what you're going to do is that you don't move to break even, but you give price the room to breathe, right? And so you're going to maintain your stop loss in its original position. And then what you are going to do is that you are going to take some volume off, right? So let's say you had your entry right in here, price makes the push to the downside, giving you like 5 or 6%. Then you can take about 20% of your volume off to secure the risk that you took. So if you risk, let's say $100 to pick the trade, and price moves about, let's say $600, right? You just take some volume off to cater for the initial risk that you introduced into the market, right, to take the trade. So instead of moving to break even, you don't move to break even. You leave price at where it is, and after a percentage of price movement, you do what? You take 20% volume off, depending on your risk appetite. You can decide to take maybe half the risk off and wait for price to do whatever it wants to do. Most of the times, it is advisable to give the market room to breathe, right? So yeah, these are the two powerful techniques that I use. You first have to either wait for that low to be taken out. So you enter a trade in here, you wait for this lows to be taken out first before you move to break even, or you can what? Leave the stop loss in its original position and take some volume off, right, to give price enough room to breathe, right? So this is where I'm going to end this video. If you found value in this video, please do well to give this video a thumbs up and leave a comment in the comment section. Don't forget to also turn on post notifications so that you don't miss out on other future important videos. So see you in another video next week.